You open your banking app on a Tuesday morning in Frankfurt. Your coffee is still hot. The notification says your Tagesgeldkonto paid you €3.80 in interest last month, on €20,000. And somewhere in the same city, a portfolio manager just moved €400 million in Bundesanleihe before you finished reading that number. That is not bad luck. That is the bond market. And it is pricing your mortgage, your savings, your pension, and your employer's ability to keep you on payroll every single day without you ever once looking at it. Germany sits inside a €145 trillion global bond machine. The piece of it that matters most to your life is the 10-year Bundesanleihe, Germany's federal government bond, currently yielding around 2.6%. That number sounds technical. It is not. It is the single most important financial figure in your daily life, and most Germans have never checked it once. Here is how a bond works. The German federal government, the Bund, needs money. Instead of going to a bank, it borrows directly from investors. You hand over a fixed sum, the principal. The Bund promises two things back: a fixed yearly interest payment called the coupon, and your full principal returned on a specific future date called the maturity. That is the entire instrument. A piece of paper that says, lend us money now, we will pay you annually, and we will give it all back on this date. Simple. What makes it powerful is scale. Germany's total national debt currently sits at approximately €2.4 trillion. The annual interest bill alone is running close to €40 billion a year. That is roughly €1,096 every second, paid from your taxes, at rates set by the same market that prices your Baufinanzierung. Now here is the one rule that makes everything else in this video click. When interest rates rise, the price of existing bonds falls. When rates fall, existing bond prices rise. The two move in opposite directions every time without exception. Here is why that matters in euros. Suppose you buy a €10,000 Bundesanleihe paying 1%. Pays you €100 a year. 6 months later, the European Central Bank raises rates and the Bund issues new bonds at 3%. Those new bonds pay €300 a year for the same €10,000. Now you want to sell yours. Nobody pays €10,000 for a bond paying €100 when they can buy one paying €300. The price of your bond drops until your €100 payment represents a competitive yield. At 3%, that price falls to roughly €3,333. You have not lost any future payments. But on paper, your €10,000 is now worth €3,333. That is not theory. That happened across Europe between 2021 and 2023, and millions of Germans felt it inside their pension funds and Rentenfonds without anyone explaining why. Here is where your mortgage enters the picture. When a German bank, a Sparkasse in Stuttgart or a Volksbank in Munich, decides what rate to offer you on a 10-year hypothek, it does not invent that number. It looks at the 10-year Bundesanleihe yield and asks, why would I lend money to a private household for 10 years when I can lend it to the German government risk-free at 2.6%? The answer is it would not unless you pay more. So the bank takes the Bundesanleihe yield and adds roughly 1.5 to 2 percentage points to price in your personal risk. Run the calculator now. Thomas is buying an apartment in Leipzig. He takes a €300,000 mortgage at a fixed rate of 4.3% over 10 years with a 2% annual Tilgung. His monthly rate is approximately €1,575. Now the 10-year Bund yield rises by just half a percentage point. A routine move the bond market can complete in a single week. Thomas's mortgage rate moves to 4.8%. His monthly payment becomes approximately €1,650. That is €75 more every month. Over 10 years, that half-point shift in a bond market Thomas has never visited costs him €9,000. Here is the comparison that changes perspective. His colleague Lena buys a similar apartment in Dresden at the same time. She locks in 1 year earlier when the bond yield is lower, securing a rate of 3.7%. Her monthly payment is roughly €1,500. Same city size, same loan amount, same bank, same creditworthiness. The only difference is when the bond market moved. Lena pays €18,000 less over a decade than Thomas. Not because she negotiated better, but because she crossed the calendar at the right time. Now look at the retirement side. For decades, German financial advisors recommended a simple rule as you aged. shift out of action and into Anleihen. Bonds are the safe part of the portfolio. The equity portion grows your wealth. The bond portion protects it. A balanced Mischfonds, 60% stocks, 40% bonds, was considered the conservative, sensible default for anyone within 10 years of retirement. In 2022, the European Central Bank raised rates sharply after a decade of near-zero policy. The ECB deposit rate went from -0.5% to 2.5% within 12 months. Apply the rule from the first act. Rates rise, existing bond prices fall. German government bond funds lost roughly 12% in 2022. The broad Euro aggregate bond index lost around 13%. A balanced German Mischfonds lost approximately 14 to 16% in that single year. The safe sleeve did not catch anyone. It fell alongside the equity sleeve for the same reason. Rising interest rates punish both at once when rising rates are the source of the problem. The hidden number inside that collapse is called duration. It is printed on every bond fund's fact sheet, in the section most investors skip. Duration tells you how much value a fund loses for every 1 percentage point rise in rates. A retiree in Hamburg with 400,000 euros in a broad German Rentenfonds with a duration of 6 loses 24,000 euros for a 1-point rate move. A retiree with 400,000 euros in a longer-dated fund with a duration of 15 loses 60,000 euros for the exact same move. Same person, same capital, same rate shift, 36,000 euro difference. Duration is the difference between a bruise and a broken leg, and most German investors have never looked it up. Here is what the headlines are not telling you. The Bundesbank reports that the average German Tagesgeldkonto today pays roughly 1.5 to 2% on savings balances. But 3-month German Treasury bills, B-bills, are currently yielding around 3.3%. And the best Festgeldangebot at regulated EU banks, fully covered under the 100,000 euro European deposit guarantee, are offering between 3.5% and 4% for 12-month terms. 3 instruments, same legal safety, dramatically different returns. The only variable is which institution holds your cash. Take the Hamburg retiree again. She holds 60,000 euros in a standard Tagesgeldkonto at 1.5%. That earns her 900 euros a year. If the same 60,000 euros sat in a Festgeldkonto at 3.8%, it earns 2,280 euros. The Festgeld option earns 2.5 times more on identical capital, with identical deposit protection under German and European law. Over 5 years, staying in the low-rate account costs her 6,900 euros in interest she never collected. The Bundesanleihe yield takes 5 seconds to look up. When it climbs, your Hypothekenrate climbs with it. When it drops sharply, the bond market is usually bracing for an economic slowdown that will affect your employer before it affects your bank statement. It is the closest thing the German economy has to a check engine light. The bond market is not something wealthy investors do in Frankfurt boardrooms. It is the invisible architecture that prices your rent, your mortgage, your pension fund, and the interest your savings account pretends to pay you. Every euro in your financial life passes through it. The people who understand how it works are not smarter than you. They simply never accepted that it was boring. If this opened something for you, subscribe. The next video goes even deeper into your money.